So there's a large and growing literature that is found in the accounting journals that is done by accounting academics, focusing on issues related to banks, bank accounting, and bank regulation. I think there are some people who may think that, or may feel that that type of work should not necessarily be done by accountants, but should be left to finance or economics departments. Personally, I disagree quite strongly with that because really information is at the heart of the banking industry. It's vital to bank regulation, and we as accountants, I think, have a competitive advantage to understand and deal with issues surrounding information. That's what accounting is, after all, is information. And so with that background, we have decided to have a panel here discussing issues related to banks and bank regulation. Now, as the five of us were on a call discussing, what specific topics we would talk about, it was unavoidable that we arrived quickly at the new credit loss impairment model. As I think at least the three in the middle here said, they spend 90 to 95% of their time right now thinking and talking about and working about issues related to CECL. And so given the limited time and the fact that nobody on the next panel broke their legs, we decided to focus our comments on CECL and CECL-specific questions. I think there's a lot of opportunity for academic research to be valuable and informative to regulators and standard setters in that realm. And so that will be the focus of the comments from the panelists and a few of my questions. But that being said, if any of you have questions that are unrelated to CECL, the panelists have also agreed to answer those to the best of their ability. So with that, I will go ahead and pass it down the line and ask that the panelists briefly introduce themselves. They've also been asked to give a few minutes of opening remarks, and from there we will open it up to Q&A both from myself and from the audience. So we'll go ahead and start with Hal.
First of all, I'm the same person that was on the earlier panel. And Kurt was very thoughtful in getting me to buy into the disclaimer. So disclaimer still applies, the views expressed, blah, blah, blah. Okay. Just quickly, background, I spent the first third of my career as an auditor, as an audit partner at EY in financial services. I then started a securities firm and became a sell-side analyst, and then became a buy-side portfolio manager, and then became a board member. So it's kind of your standard methodology to become a board member. Do a lot of different things, and somebody will hire you. In terms of this particular issue, this has been an issue near and dear to my heart because virtually everything I've done in my professional life was related to financial services. I've audited, I've advised, and I've invested in bank stocks. So there's a little bit of passion here. So what I wanted to do is, given the objective of the overall conference, I want to give you a set of slides here that give you a little bit of history, what problem were we trying to solve, talk a little bit, and the reason I wanted to do this is because it really hits at the prior panel's topics. How do we use internal research and external research? And the first couple slides are really internal and external research. It's a way to look at it, and I've given you a couple sites as where the numbers and things come from. Then as a quick summary slide, what does the standard say? Because I figured not everyone in the room knew exactly what CECL was, so got one slide on that. And then a series of slides that are really the hot button debate topics that are going on today, and I translate debate topics into research opportunities. So the last few slides are going to be exactly that. So let me just go very quickly. The first three slides come right out of a congressional briefing book that we did just 2 weeks ago. We've also used these same slides or similar slides to meet with the heads of each of the regulatory agencies. And I picked ones that when we talk to particularly the regulatory agencies, come out, now I get your point. I see why you did this. So very quickly here, there are significant changes in risk. And this graphic is just one way, and this is from Moody's Analytics, talking about prior to the crisis, what was the shift in risk in the marketplace. So a bunch of different ways to look at it, but there's a lot of information packed in. I won't go through it all. If you get at a break, you want to talk in more detail, I'm happy to do that. But there was clearly a risk shift in the marketplace. Now, and I've color-coded here, the risk shift was in the green area. It basically says in the 3 years leading up to the crisis, loans increased 35% in the country, reserves went down 10%. They were such good quality new loans, those 35 new loans were so good, they had no loss content. In fact, they were so good they healed past sentence. Go back to the previous slide. We know that's not true, but this is what the accounting was telling us. So there's a misalignment. Problem number one, misalignment. Problem number two is I put it more in the category of transparency, and I'm going to try to get to the that green shaded area here is that period when risk was going up. And what this graphic is showing you, and this is the way I looked at it as an investor, how was the market responding to this shift in risk? And I would call the black portion of that lowest line there a pretty flattish response. Higher risk, market not responding, but then look at the acceleration of devaluation in the bank stocks relative to the market. That red line shows basically a devaluation of bank stocks. And then I circle where the allowance hit a low point, okay? So what this is telling you is the market responded earlier to rising risk than the accounting did, but not as early as perhaps it should have. So we're dealing with two issues, misalignment of accounting versus changes in risk and the transparency to the marketplace. In terms of the primary principle, we've tried to really keep it simple here, and this is a graphic I've used particularly with investors. Basically, the standard says, what did I lend? What do I expect to collect back? And book the difference. A minus B equals C. That's what the standard says. And we can walk through all the literature here. In the upper right-hand corner, I actually give you the paragraph where I'm going to say I put it in not accounting speak and COD speak, but investor speak. What did I lend? What do I expect to collect back? Book the difference. That's what the standard does. Now, let's get on to the important stuff for you guys. Debates. The first one is this something called, is the standard pro-cyclical or counter-cyclical? There are many different ways to identify what's pro and counter-cyclical. Those who are opposed basically say, look at the red line relative to the black line. The black line is what actually happened in accounting. This is loan loss reserves relative to loans. And you see that the black line peaks after the recession. There's a sharp run up and it peaks after the recession. In some of the research that's been done, the red line is trying to simulate what would have happened if CECL were in effect today. Now, that suggests that the reserve only has to go up 29% from the beginning of the recession versus 264% under the incurred model, and that's what happened, okay? But those who are opposed say, look, you're in the middle of a recession, your reserves are, if they had to go up and they peaked, that's bad, it'll shut down lending, right? So that's the debate here, and I think there's some interesting research that can be done, that has been done and will continue to be done around this area. Now, let me take the other side. I showed you the balance sheet on the first slide. This is the income statement impact. Again, I highlighted the green box under the black line. That's basically what did happen. The red line is what would happen under CECL. The important thing to keep in mind here is that it doesn't matter how you account for it. Oops, sorry. It doesn't matter how you account for it. In the lower right-hand corner of the table, all answers come back to the same loss. Accounting only changes the timing of the loss. It doesn't change how much of a loss you recognize. So it's important to keep in mind. But this timing notion and kind of preparing for risk that is building or waiting, pay as you go or pay me now type of approach, that is somewhat controversial right now. Another debate extends from, because you're making me book more reserves, I'm not going to lend as much. And I think this graphic, it takes a little bit more explanation, and I won't go through all the aspects of it, but it basically shows you before recession, after recession, what happens during recession. The argument is basically I will stop lending because of CECL. Well, you actually already do stop lending. In fact, your portfolio shrinks, so that argument kind of starts to fall away. You're not having as much loan growth as you've had in past cycles. What you've done is, because deposits come in, I can only invest 72 cents of every dollar now of deposit money into loans. I used to invest 100 cents of every dollar before the recession. What do I do with that 28 cents? Buybacks is a big source of this. So the argument, if you're opposed to CECL, is we're not going to lend anymore, it's going to destroy the economy, and on and on. Maybe an alternative view is maybe you won't buy back as much stock, okay? And then this leads you down the path of what impact would it have on buybacks, and is that, are you better off lending or buying back your stock? Another area of debate is transparency. Some have argued, and what this graphic tries to show you is on the left-hand side, this is current GAAP that went into effect in 2011. It gave you credit quality indicators for each of the loan portfolios, and it breaks it down by your best rated loans, your next best rated loans. So you get a sense of shifts in credit quality and what's going on at each individual bank. Very useful disclosure on the left-hand side. We had some debates about what to do to give greater transparency. We ultimately ended up on the right-hand side, taking the left-hand graphic and according it out and breaking loan pools down by vintage, because the underlying belief and data to support this is underwriting changes over time, and you can quite often track those changes in credit quality by vintage. So from a research perspective, think of it as a 7-fold increase in the amount of data. You should be very happy with that aspect of it. And you also have comparison. Here's what you were provided in 2011. Here's what you're going to get in 2020. Did that expanded disclosure, how was it used? Did it actually provide decision useful information? There's a lot more to that story, but that's another area worth exploring. And then finally, we spend a lot of time going out and talking to banks to the point that we sometimes actually have to sign non-disclosure agreements. So anything I'm saying here today is not in that category, but we've been able to do some really deep dives into companies. And what we've heard both in the US and from European banks is what is on the screen. Basically, as a result of the standard, along with stress testing and other things, the banks have had to go in and clean up data, so they've got better data. They've had to improve internal controls around the larger databases. They've had to improve their estimation processes. Some have told me that would have happened anyway as technology improves, but it's certainly been attributed to CECL and better communication and coordination internally, which they expect to lead to better risk management, pricing, capital allocations, credit decisions. The cost, another area that I'd be interested in academic research in, is, okay, so they had to clean up their data. Is that really a cost of the accounting standard, or is that a cost of technology improvements where I can store more data, use more data through artificial intelligence, other things? Is that really an accounting cost, or is that the world's changing and we shouldn't attribute that cost to it? I think there's some interesting cost-benefit studies that could be done from this particular standard, because there's so much going on, and it affects virtually every aspect of these the banks that we're talking to. So I'll stop there.
So that was a lot of information. So that was great. I've seen versions of the slides because we've been at different presentations at the AICPA or Interagency Accounting Conference, but each time you've got different really interesting slides that you want to spend some time with, and I've seen that, a lot of those slides before.
I didn't pay her to say that. So.
One slide that I wonder if it would be interesting would be to take the underwriting slide you had where you showed the change in Alt-A and subprime and put the allowance on it, whether it's the allowance or the provision, to show just the changes that were happening right when the risk was increasing.
That's what I was trying to do, but that was for allowances for the total industry, but breaking it down. There have been some like that. I'll see if I can pull that.
Okay.
I got a homework assignment. Thank you.
Well, yeah. Well, like I said, that might have been that second slide after it. It just was hard to digest that in the moment. But I am Joanne Wakeham, and I just recently, as of April 8th, changed jobs. But I was the chief accountant for the Federal Reserve. I still work for the Federal Reserve, but now I'm over strategy and communications. Really enjoyed, I've done accounting all my life. So I went to Clemson, got an accounting degree, then went and worked at the FASB, had a postgraduate internship after that. Then I went and worked for EY in Atlanta, and then worked at the OTS, and did that for a while, and then started working at the Fed, and then, kind of worked up my way up through manager, assistant chief accountant, and then chief accountant. So I've always worked in the accounting area. One of the things that I've always said is every single number anybody touches in a bank agency is an accounting-based number. Like, there's no way that accounting doesn't matter or accountants don't matter as it relates to bank regulation, because, as I'll explain in a second, every single tool we have is based on accounting-based numbers. I have a disclaimer as well. Anything I'm going to say is my personal view, not the view of the Fed, so I just want to make that statement. So yeah, so we have regulatory capital, we have stress testing, we'll do ratings of banks, we look at earnings. Earnings is more straightforward when you think about like accounting. But regulatory capital, we start with GAAP capital. And stress testing, we start with the GAAP balance sheet as the day zero balance sheet that then is stressed, and projections of losses are laid on top of. The reason, there's a regulation, FDICA, that says all the banking agencies are required to have reporting standards that are based on GAAP, or at least no less stringent than GAAP. And what that does, in my view, is it's a very objective framework set by a third party that's around this idea of transparency. And then it doesn't shift based on whoever's in charge of the bank agency at the time. It is an objective basis for our standards. Then we look at regulatory, then we base regulatory capital. So we'll take GAAP capital, and then we'll back out things like goodwill, which we feel like from a safety and soundness perspective, if a bank were to fail, you wouldn't be able to recover. So based on our paradigm and frame of reference, we'll start building a regulatory capital, I'll say regime, but using GAAP capital as the basis. Stress testing, the same thing. What will be the GAAP capital number approximately? Certainly stress testing, you're just getting, it's not precise because you're doing forecasting, but what approximately might be a GAAP capital number, and then a regulatory capital number that's kind of based on top of that. So accounting and GAAP capital are very important to us, which is why we have an accounting group that is around issuing, working with understanding what the FASB rules are, providing comments, taking whatever the FASB decides, and then figuring out, what are the implications for our institutions. Part of that is saying, okay, we've got our regulatory capital and stress testing rules. Does anything need to change now that the accounting has changed? Sometimes we know the accounting is going to change, and so we build our capital rules knowing that we are going to see a change from incurred to expected. That's what happened with CECL. So when in 11, 12, 13, when the Basel Committee was working out what would be regulatory capital rules, and the Basel Committee is a group of, I'm not sure how familiar everyone is, but has all the different, many countries participate in the Basel Committee, and then the idea is to get some kind of a even playing field around what the regulatory capital rules in every jurisdiction. So generally speaking, each country tries to implement the Basel rule. So when that was going on, we knew the accounting standards were changing. It was post-crisis. We knew that there was a goal to move to expected credit losses. So we thought, that was something that we knew was happening when we were thinking about the capital rules. Even, that being said, if you were at the banking agencies had testimony in front of the Senate and House banking committees or finance committees, and the CECL came up, and one of the things that our vice chair said was, we're monitoring the impact of CECL, and then we will continually assess whether we need to make any changes in our regulatory paradigms based on this change in accounting. So it's something very much that is part of our day-to-day and how we think about regulating banks. We do have accountants that work on it. Each of the reserve banks have accountants. We have an accounting group at the board to work on guidance for banks, and then also, I'd say if we find out that an institution has an accounting practice and there's a question over whether it's okay, they contact us if it's material. So we look at material accounting issues to make sure banks are accounting for things correctly, because we want the regulatory capital and stress testing number to be correct. As it relates to research, as I think about it, or one of the areas of research is what is going to be the impact. So it could be from a standpoint of doing where we might engage some economists and do some forecasting. What do we think the impact of CECL is going to be in a benign and a downturn, but also more judgmentally around what's the impact for community banks. So community banks talk about burden, and so can we assess what the impact is going to be on community banks, and then what kind of guidance would we have to ensure community banks understand the relevant, realistic, practical ways that they can implement CECL that, as a regulator, we think are reasonable approaches. The other thing I would say, and this gets to one of the slides Hal had, pardon me.
My slides caused me to choke
I'm
up. I like
choking
that.
up, Hal, is that credit is cyclical. So this whole conversation about whether CECL is pro-cyclical or counter-cyclical. The credit cycle itself is banks make loans, they have certain underwriting. Hal showed how underwriting changed. That results in losses. So underwriting, originating loans, the credit cycle, that all impacts losses, and then the accounting is just representing in a certain way for the financial statements. But accounting itself doesn't generate losses. So the Office of Inspector General goes in and looks at when banks fail, bank failures, and then they'll say, okay, this is how, as a bank regulator, you could have changed it. So we'll meet with people while they're doing their study. So during the crisis, or right after the crisis, somebody came in and said, if you would have made them record the allowances sooner, that would have prevented the losses. So I was trying to explain, no, the accounting doesn't prevent the losses. The accounting is reflecting the losses. Now, one of the things about information is if you have information early enough, it can change bank decisions. And so that, that kind of what Hal was talking about in terms of investors, you can also think about bank management. Would they have continued to make the volume of loans with that particular underwriting if they had earlier information that these kinds of loans result in higher losses? So that's, accounting early information, and then the accounting of it can change investment decisions, but it would not be appropriate to say, accounting per se creates losses. And then the last thing I'll say is about data. And I'll say maybe the cost of data. For stress testing as well, we asked for a lot more data, and then we wanted to make sure that data was correct. So we wanted to see what the controls were, and the examiners would go in and look at the controls around the data. So a lot of the feedback from the firms has been that stress testing, you could argue whether, you could tweak it and say you should have less cumbersome rules around stress testing, but stress testing itself improved the banking system. And on the data side, they realized that they really didn't know what, they didn't necessarily have, the controls that they would really want to have, ideally around the data. And so it helped improve the data. And so from a CECL perspective, I think it's the same kind of thing is happening. It's improving processes and controls around data, which helps banks make better decisions. And so I think about that, when you think about the cost for banks of any size around data, part of that is saying, do you know what the, if your whole mission is to originate loans, you probably want to have good data around what kinds of loans result in what kind of losses. So that's how we think data is actually good for a bank, and then having the cost around maybe improving your controls is helpful, productive. So that was the alarm that Tom set to say, Joanne. Tom.
Sorry about that.
Yeah.
My name is Tom Yerseisen. I'm a partner at E&Y. I don't have a disclaimer, but I can assure you that if I say anything wrong today, my firm will disclaim me. So let's leave it at that. I've been serving banks since I started with the firm over 20 years ago in an audit and advisory capacity. Right now, I currently lead a large bank here in the U.S. On the audit side, but I also lead our credit impairment team in our national office. So spending, as Mike alluded to, a lot of my time on CECL. And what we're focused on right now is really three broad objectives. One is we're spending, obviously, a fair bit of time evaluating and interpreting the standard so that we can give our banking clients and others some real guidance on how they take what's in the standard and apply it, in their financial statements. Spending a lot of time with both them, the standard setters, the regulators, making sure that we get all of those stakeholder perspectives as we think through some of those significant issues, and obviously coming back to the FASB, where we think we're at a bit of an impasse or where there's multiple ways to solve a particular problem. The other area I think we're spending a fair bit of time is just, executing our own internal readiness plan. This is I've said a number of times, I think this is a significant accounting standard for all the banks to deal with, but there's a lot of audit judgment, a lot of judgment that management's gonna have to deal with, and a lot of judgment that the auditors are gonna have to deal with. So we've been focused on educating our clients, making sure our team's gonna have the right tools on both the accounting and the audit side to be able to address the risks in the standard. And to make sure that we've got a mechanism in place as we go through this year leading up to implementation for public companies and the year after, in their first year of dealing with the standard, that we can monitor our performance and monitor our clients' performance. And then the last area where we spend the time, and this is where I get the most value and kind of interest in what I do, is we get to go out and spend time with our clients and understand what they're facing, both from an accounting and from an operational perspective, because there is a lot to do to get ready to implement and deal with the standard. I thought what I might do as we think about kind of the questions that are coming is maybe provide a little bit of information as a backdrop in terms of where we see the industry's readiness. And I think it varies. So I think largely the banking industry, we feel pretty good about where they stand overall. Certainly the larger institutions have had a bit of a leg up, to the extent that they had CCAR or DFAST. Many of them are leveraging that technology, some of the data that you referred to, Joanne, and some of those underlying processes. So they had a bit of a head start. And the ones that have international operations probably were even a little bit further along in the sense that they had to deal with IFRS 9, which was effective for them over the past year. As you kind of move down in terms of size of the organization, the mid-sized institutions, and we were talking about where do you draw those lines, but really from my perspective, maybe 50 billion and up, we think they're also in pretty good shape. They're probably a little bit further behind than the larger institutions, but they also have some of that CCAR and DFAST background to give them a head start. And they have a little bit more capacity, really, to deal with this significant change. When you get below that, it really varies quite a bit. And we were talking about $100 billion institutions versus $40 billion institutions. Obviously, the continuum of their readiness is pretty extreme. For the smaller institutions, the biggest challenge that they're working their way through right now is many of them have gone out and hired vendors to help them with either data, with modeling, with implementation, really kind of any element of the implementation process. And they're working their way through, are they getting what they need? Is it CECL compliant? Is there anything else that they're going to have to layer on top of that vendor solution? And I would suspect that will be a really significant lift for them as they make their way through 2019. We feel generally good about maybe the $10 billion and up institutions about getting there. But it is going to be still a bit of work as they go through the remainder of 2019. So something to watch. I think for all of you that are interested in data, the one thing that's been lacking to this point is any public disclosure of what impacts are. So we've seen JP Morgan, Citi, and Wells, and then largely nothing else beyond those institutions. And what we're hearing from our clients is we probably won't start seeing quantification until at least Q3. From everybody else that's not on the list I just rattled off. And many of them, particularly the smaller institutions, might be Q4. So that is going to put us all a little bit of a disadvantage in terms of what we expect the impact to be over time. Maybe one or a couple of observations just around the implementation process. Hal, you had a great slide up there around some of the benefits of the model. One thing I think I would say without question is the level of engagement of the non-accountants at the banks in implementing the standard is very, very high. And whether that's because they like the standard or they don't like the standard or not, I don't know. But generally, there's certainly much more connectivity to what the risk managers are thinking about, what the business folks are thinking about. They're thinking about questions around pricing. They're thinking about questions around product availability going forward. They are evaluating this kind of pro-cyclical question and what it will look like when they have to lend in a crisis. But that level of engagement at a minimum is very positive, as is the increased focus on methods and data, because we think that will produce much more reliable results. I think the caveat to all of that is, again, depending on the institution size, the standard allows for quite a bit of flexibility both in method and assumptions. you are going to see a lot of variation in both methods and assumptions across the banks. And the quality of the disclosure is going to be absolutely critical to be able to compare Bank A to Bank B to Bank C. So that is, to me, the biggest open question that we're looking forward to seeing getting solved as we go through the next 6 to 9 months.
Hi, I think most of you probably know who I am. I'm Ann Beatty. I'm a professor at Ohio State University. You may be less familiar with my background in terms of how I got into doing research in banking. I started out my career at Wharton just when they got the Sloan Financial Institution Center grant, and we had a proactive associate dean who wanted to get us involved. So I started there. That was right after the S&L crisis, et cetera. There was a lot of interest in banking at that point. I did spend summer at the St. Louis Fed. They actually paid me to write a paper for them, which I did publish in their review. It did go through peer review. It had to go to the Board of Governors, and someone had to read it and make sure it was okay. But that's a little bit different model maybe than what we see in the FASB. And I was part of their research department. Most of them were macroeconomists at the St. Louis Fed, but they had a few people who were doing banking. So I did banking research for a while, and then people decided banks were boring because everything was going along so smoothly. Who needed to do research in banking anymore? And then when the financial crisis hit, I was inundated with papers to review on banking, and many of them, the authors actually didn't know a whole lot about banking before they wrote the paper. So I was like, well, I should get back into it. And, you know, I've obviously been doing some more research on banking since the financial crisis. I wrote down some comments, and some of them I think are relevant given what was said before, and some less so. But one thing that I did want to mention, because I think sometimes people wonder why it is, they wonder what's special about banks. Are banks actually special? And reason that I saw, which resonated with me, was the ability to transform risky assets into securities payable on demand at par. So that is actually an unusual characteristic of banks, and so it makes them different from other financial institutions. And then, you know, U.S. banks are important given the U.S. dollar is one of the dominant world reserve currencies, so U.S. banks in particular might be interesting. I think that U.S. banks are also interesting related to CECL because, well, the banks have said that CECL is the most important change to bank accounting ever, and I love hyperbole, so I love the fact that they said that. But when you think about it and compare it to IFRS 9, CECL is a much larger accounting change than IFRS 9 was. So if you think about Basel and trying to, have similar rules, it might not be the same. One thing that came up, at least in my mind, in the earlier session was the idea of providing information to investors was what was said in the previous session, but recognition versus disclosure in accounting is a long-standing issue, and a lot of what's said is about what information we have and when we have that information, as opposed to does it matter when it actually hits the recognized financial statements. And I would argue if nowhere else, it matters in banks because of the link between regulatory capital and what's recorded for GAAP purposes. So, Hal mentioned that there are even more disclosures, but there are a lot of disclosures about the credit quality of banks, either GAAP disclosures or regulatory requirements. So we know their non-performing loans, we know their charge-offs by loan type, we have fair value estimates, et cetera. So if what we're concerned about is information, I think we have to think about recognition versus disclosure. There's currently a fair amount of, we heard that there was no research on having been done on CECL at the first panel. I felt bad for the people in the audience who have done some of that research. But there has been research that has looked at expected loss modeling, et cetera. And what we know is, given the information that existed, the disclosures that existed previously, using those disclosures, we could have done better than the GAAP rule. So I don't know, in terms of information, that the right benchmark is the GAAP rule. Whether or not the same will be true under CECL, that we will no longer be able to do better than what CECL can do, given the other disclosures, I don't know, because we haven't run that experiment yet. So CECL will definitely change recognition. It may or may not change. It probably will change the information set too, right? Because banks are collecting a lot of information, but it may or may not change the information set. The other thing that I did want to talk about is the issue of timing, and Hal didn't emphasize it too much, but timing is everything. I mean, all accounting is timing. So if it weren't for caring about timing, we could just use cash basis accounting and we could disband the FASB and we'd be done. So to say it's only timing is, timing is everything, right? So, the issue in my mind, at least, and this is perhaps based on my bias from research that I've done, is that a lot of the procyclicality associated with the incurred loss model was because of when the losses hit regulatory capital and then the need to replenish regulatory capital at that time. Hal put up stuff. If we're good at predicting economic downturns, then CECL should be less procyclical than what we had before. And if we're bad at it, it's actually possible that it could make it worse. And the question is how, and Hal put up stuff to say we're not as bad at it as some people have said we are based on macro forecasts, but I do think that remains to be seen. The other thing that I wanted to talk a little bit about is pushing activity out into the shadow banking system. So regulated banks have to meet regulatory capital requirements. Shadow banking does not. And then the question is, could that be an unintended consequence of making regulatory capital more expensive for the regulated banks? So I just ran across a very nice theory paper that that modeled the fact that the shadow banking is inherently more procyclical than regulated banking because of what makes banks special, and that is, in the shadow banking, the claims don't have to be at par, and they become very illiquid, and so the shadow banks are actually more procyclical than the banks, and so when we start increasing the wedge between the regulated banks and the shadow banks, that could cause procyclicality because of the movement of the activity.
I'll give Hal a quick chance to respond to some of the things that were said, and then we'll open it up to questions from the audience.
There are a lot of comments made about, and not just Dan, but those who are opposed to CECL will say, well, I can't predict the economy, so therefore we shouldn't do anything. The standard is much more about trying to align the accounting with changes in risk. And I think that's something that banks actually know a lot about, because they know that their profitability, if they take more risks, they can maybe make some more money. And there are a number of data sources that I've used in the past, including the supply and demand graphics at the Federal Reserve. And it's a senior loan officer survey that basically says, are you being more aggressive in lending or less aggressive in lending? Are your customers demanding more or less? Those have been out there, and they've been phenomenally good predictors of when you're going to have more losses. Right? So a lot of it is not about the economy, but it's about how you changed your risk profile, and this accounting tries to align more with that change in risk profile and not project the economy as much. you will never get the economy right completely, but you do know from your own underwriting when risk is being expanded or contracted internally, and that's really what the standard is about.
And I'll just add on something on that. We've seen different analysis, like BPI did an analysis, Moody's did an analysis of the impact of CECL. One thing that's interesting is the assumption, what indicators a particular study might use, like leading indicators, let's say, versus lagging. So we think about underwriting as being a leading indicator, like that, what Hal just said about taking on risk. Unemployment, particularly for this last crisis, because the crisis came out of the banking industry, which then led to unemployment later on. Using unemployment definitely is a lagging indicator, and so you end up with very lagging recognition of the change in the economy if you're going to use unemployment. But if you use changes in underwriting, you would pick that up much sooner, kind of as Hal's graph identified. So I think one of the things that we think about with any analysis we see is, what are the key assumptions that are being used, and then we try to lay out the different analysis so that by looking at the analysis we can make some assessments about what we think the impact would be, because every analysis at least at this point is going to be based on a lot of assumptions. So it's key to look at the assumptions.
All right, so I came prepared to ask a number of questions, and I wrote down several more as they were speaking, but given the time limits here, I'd like to open it up to see if any of you have anything you'd like to ask the panelists, and if not, I'm happy to go down my list. There's a couple over here.
My question relates to how supervisors are really going to change their practices in response to CECL. We heard a lot of talk about how banks are going to adapt to this practice, but I think the efficacy of implementing CECL kind of rests upon the day-to-day or the supervisors that are going to go out in the field and kind of change their methodology from more of an incurred loss to an expected loss. And from my experiences talking to examiners, they really live and breathe this incurred loss model. And so I was wondering if any of you could speak to the challenges that exist to kind of changing their expectations for how to view loan losses in the wake of having to shift to this new standard.
Yeah, it's a great question. It gets to change management. Probably the audit firms also are trying to think about how do we educate our staff in such a way that by the time it's implemented, they feel like they've got a good set of, they understand the standard and what we expect from the supervisory perspective. So we started a couple years back what we called a multidisciplinary group at the board, so that we had an examiner, we had an economist, we've got people from credit, we have accountants, and we developed training. And so we have identified people at each reserve bank, and then we're trying to get training. We're training the trainers, so to speak. We're going out to all the reserve banks, and we've got a multi-phased process, different channels to try to train examiners to understand what the new standard is. So one is just education and training. The other is what kind of lens they use when they're taking that CECL knowledge and going out to institutions. So for the first, at implementation, what will be the lens that an examiner uses for the largest banks? What will be a lens that an examiner might use for a $500 million bank? So we're trying to talk about tailored expectations, and that somebody who's going to both a $100 billion bank and a $100 million bank will know to use a different lens when they're looking at how the standard is implemented. So we're trying to really look at that. That is certainly an issue that we're focused on and have spent a lot of resources trying to get it right.
Just one additional comment, because we've been there with you and trying to get out there and get the message out, what the standard says and what it doesn't say. And one of the interesting things about this particular standard, I'm sure it occurs in others, but here you've got a large number of service providers that provide services to financial institutions, and a large portion of our time has been dispelling myths about what the standard says. And I've gotten really strong pushback from particular banks, and I have to buy external data. Well, it doesn't say that anywhere in the standard. In fact, it says just the opposite. If internal data is better than external, you don't use your internal data. I said, where did you get that information? Why do you think that? Well, that's what the consultant told me. Well, what's the consultant selling? Oh, the information that they want you to buy. So in this standard in particular, we found a lot of just myths out there that we've really had to push back against. And we've tried to arm the banks with information like presentations like this, where we walk through the most common myths, but it's still an uphill battle.
Yeah, Christian?
So I want to build on this, on the last question, which highlights this complementarity between the rules and the supervisory regime and the enforcement, where the auditors obviously also play a very important role. And here's, I think, a good example where we can learn from prior research, for instance, what the behavior of banks was under the incurred loss model. And so if we think about why was there no response in that green phase that you, Hal, were showing on your slides, the one narrative might be that the banks were constrained, and that's been the narrative. The incurred loss model made that difficult to respond. But there's potentially a different narrative that we should also think about, which has to do with the incentives to report losses as you are going into a crisis situation. And so we could, for instance, look at 8Ks, because even if under Fast Fives you came to the conclusion that no impairment was necessary, there would be a disclosure obligation. There's 5 8Ks you can find for the entire US sample where there were forward-looking statements about, we think we're going to have some losses. If you look, for instance, at the fair value disclosures for loans that banks have to do, they would not be constrained under the incurred loss model. These fair value disclosures were not forecasting the type of losses that we were subsequently seeing. So to me, a really critical piece to make CECL work has to be thinking about how we're going to enforce these standards and how we're going to get to a different place than we got to the incurred loss model, because I'm not convinced that the only reason we were not seeing more forward-looking behavior had to do with the standards, but also had to do with how difficult it is for banks to make these decisions when they're knowing there's going to be this crisis coming.
Maybe a comment there. You alluded to it earlier, Joanne. We have, as the agencies do, a program to get to all of our people to help them understand what we think the principles of the standard are, and certainly what they're not. And we're trying to kind of seed some dialogue with our clients about how are they going to behave when they actually start to see conditions change on them. But I don't think, to both of your questions, you can really underestimate the importance of that relationship between either the examiner and management, the auditor and management, any other party, because that is really going to be a significant influence to how they behave, right? Do they feel comfortable with their understanding of the standard? Do they feel comfortable with their forward-looking information? Are they ready to move before their peer banks to start recognizing losses? And what I think will be really interesting is, will they be ready to move to start releasing reserves when they start to see some of those economic conditions improve? And what we're hearing from our clients is the mind of management is still very stuck to some degree in an incurred loss framework and what their historical experience has been, because they ask us questions like, are you really going to let us release those reserves when we see that economic conditions change? Will the regulators do that? And we've tried to, and I know your teams have done the same, tried to encourage them that we're on a new journey with a new standard and we kind of have to start a bit fresh, but that interpersonal history and the interpersonal activity is really important. I think will drive different results across the banks.
And just I want to go back to your point about that green shaded box where the market didn't react, in those years leading up. I would point out that, I think it was Kenneth Galbraith who said, markets can stay irrational longer than you can stay solvent. It really applies here. I can spot risk, and I was focused on Freddie and Fannie in 2004 and could see the risk and the problems. But if I put my bet down too early, I can lose my shirt before the rest of the market. So part of it is seeing the risk, but part of it is when will the market see the risk more broadly. So I've got to be careful in terms of my timing.
But just to clarify, I wasn't making a statement about the market as in the investors. I was making a statement about the you were standing in 2008, the impairments that we were getting on the loans were substantially smaller than what subsequently ensued. And the question is, why is that happening, and to what extent would CECL change that? Right?
So I actually wanted to ask a follow-up question to both of those, and that is, under the incurred loss model, we have a decent way to assess the validity of the reserves by looking at whether they're subsequently charged off in the next 12 months or so, right? My sense is that under the expected loss model, that specific assessment of the validity of the reserves will no longer be worthwhile. And I'm curious whether there are other metrics or tools that any of you have thought about to assess the validity of CECL-based reserves, either using internal data or potentially more interesting to this audience, data that is publicly available.
Ben, you're absolutely right. The back testing, the way we've traditionally thought about it, is not going to be as effective with this model as it's been historically. We've encouraged clients to focus on elements of their process that are back testable. So things like their forecast, you can certainly look at what's come out and what you've learned from that. But until you kind of gather data over a longer period of time, it's going to be very difficult to prove out whether or not the loss estimate that you made, last December really is valid. But that is a challenge I think the industry is really struggling with. I think for those institutions that have more internal data, that are at least looking to external data, while it's not a requirement to do that, it certainly is a meaningful data point that they could look to try to triangulate about where they think they're going to be, how they think their portfolio is going to perform, and where their estimate is coming in between all of those points. That's a really good process. It's an interesting dialogue with the banks, though, because they are, some are, well, I don't want to go by the external data, or some would say the external data isn't relevant to my portfolio. And that may all be true. And then they're also, I think, connected to that concern that somebody's going to say, well, if you're looking at that external data, why isn't that the basis for your estimate? So there's a confidence in their behavior that needs to build to say, I can look at it, I can use it as a reference data point without necessarily looking to it.
I was going to say, I do find it a curious argument, though, because if you're pricing your product appropriately, what did you base your pricing on? You've got to have some expectation about, and most of this is done by pools. You're lending it to a pool of 100 borrowers. How did you price it without a key ingredient? The cost of goods sold in this case, in part, is based on your expected losses. So I think this notion that I can't predict the future is a little misguided, because that is their business to estimate the expected loss, because otherwise they can't price it appropriately.
Sorry, I just wanted to ask you, Hal, if you think they're pricing their loans properly, why do you think they have a day one loss on those loans?
Because they didn't want to go fair value. I would have been a much bigger advocate for fair value. The accounting, I think you actually, when you go out and source customers, I think you've actually created value to go along with those. You're willing to take that loss because you've created longer term value. But unfortunately, and Tom can probably speak a little bit more to this issue, the board went down a fair value approach, but for several reasons had to back away from it. I think fair value would be a much better measurement in this case than CECL.
Sorry, one more follow-up. So
No, I'm sorry.
I'm being so polite. Come on.
You're restrained, I can see it. At cocktails tonight, she will not be.
So related to that, and this was something that obviously came up in dissenting opinions, et cetera, in the standard, is why do you take the losses up front, but the increased interest revenue is spread out over the life of the loan?
Two quick observations, and community bankers taught me this a long time ago. The people who don't pay you back never pay enough interest, so there's no matching concept. Part of the argument is, well, I'm going to get these revenues, so I should be able to match the cost of those against the future revenue. So the people who don't pay you back aren't the ones that you'd be matching to, so there's not a real matching issue there. And the other is that as soon as those loans go out the door, up front you're not going to collect all that money back, so the issue becomes the timing. When do I recognize that loss? And that money that you're going to earn is earned, in fact, rent over time. And when you realize which of the customers will not pay you back is generally much earlier in that cycle versus the later people who continue to pay you back throughout the full term of the loan. So we had some debate about, well, is there a way to defer part of the loss? We had a lot of discussion around conceptually, does that make sense? Does it make sense to defer a known loss? A couple things came out. One is the bank regulator said if you defer it, that'll be a non-bankable asset, so there's no regulatory capital relief anyway. And the other is that it would be really, really complicated to provide all the disclosures about, well, we think this vintage is going to be, the loss emergence is going to be over this period, but it's going to change. And they said, frankly, it's just much easier to book all the loss up front. So there were a lot of conceptual debates around it, and some of it came down to, frankly, cost benefit.
All right, I think we've got time for one more question here. John, did you still have a question? I saw your hand earlier.
It's basically, you anticipate...
Hold on, the microphone's coming, John.
Didn't listen to our earlier instructions.
Just generally, do you anticipate that this will have real economic effects in terms of lending decisions that banks make?
Me personally, I think that because of the increased transparency into risk that's being taken early in cycles and then later in cycles, the risk is going to shift. Yeah, I think that transparency, shining a light on something will cause some to make different decisions than they have in the past. And I don't view that as all a bad thing, but that wasn't the purpose of the standard, to cause them to make a different decision. It's just to put light on it. You make whatever economic decisions you want to make. And you've had a number of surveys out there that say, no, it's not going to change our mix, it's not going to change our pricing, and on and on. But there are others who said, yeah, that we're going to have to think about this a little bit more. The other aspect is the regulatory capital, that clearly when you have higher reserves earlier, that's going to have a regulatory capital impact, and that may cause some to actually rethink, is that worth it given the return on the pricing that I can get on a particular product? Transparency will change some people's behaviors, yeah.
Yeah, I mean, I would agree with Hal, and then if I think about just volume-wise or what you get if you have earlier recognition, is that there will be, just like in the last crisis, there will be a decline in lending, but with earlier recognition, it will happen earlier in the cycle, which will allow banks to replenish capital, to have more capital in the depths of a crisis and be able to lend more than what they would have. It just kind of shifts where some of that, the change happens earlier. But like what I said before about lending, banking is cyclical, and so regardless of the accounting, when there are higher losses because of riskier loans being originated, that will have an impact on lending.
And somebody in an earlier session asked, do we use research by analogy? And I like Ann here because I actually read her research. And, that the study where you did 25,000 bank quarters, I thought was particularly insightful in terms of, those who reserved earlier were less likely to cut back on lending than those who reserved later under the incurred model. And by analogy, since all of CECL is pushing reserving earlier, can you make that inference? And I think that there's some real logic that says, yeah, you can.
Yeah, I won't comment on the long-term economic impact, but I just maybe a caveat for everybody to think about. The thousands of banks that your agency and the other agencies supervise, vary in significant degrees in terms of their relative capital positions, and they vary in significant degrees relative to their sophistication. So while there are some institutions out there who certainly can price risk really effectively, there are others who are largely being pressured by what they're seeing in the marketplace and moving only as fast as their peer banks in that community are moving. And so I think that is a really important ingredient to whether a bank cuts back on lending, continues to lend through the crisis, and there may be some interesting things to think about there relative to whether or not that will provide outsized opportunities to institutions that are either larger or more sophisticated or just have a stronger capital base as you go through that cycle, whether there'll be changes in market share between the banks. Something to think about.
All right, I want to thank the panelists very much. I think they provided a lot of food for research thought for us. We will not have a break between this panel and the next panel, so the next panel will be up right away. But thank you very much.